Welcome back, everyone, for our weekly Market Insight Show. We're so pleased that each of you take the time out of your busy schedule each week to join us, and we're seeing the audience grow and grow each week. And that's because you, the listeners, effectively you providing the content you're provided by the questions helps drive this material week after week. And also thank you so much for those who've shared this to your friends and family and social media across the board. Do appreciate that. Thanks for doing that. We're going to take the next 30 minutes to give you some market insights. The focus for this week is around ESG, and I think that's for good reason. We have a new special guest with us. We have Paul Riccadella from the MSCI. Please, the MSCI is actually going to join us for the next 2 weeks and provide us their insights in the overall marketplace, and we're going to talk about that in a second. And I'm also happy to introduce Mark Rays one more time. He's the head of product of BMO GAM. So thank you guys for joining us on this session. Now I just want to advance through some of the legalities here. Bear with me. Some disclaimers. Really want to highlight more than else that effectively we're not providing advice here. We're effectively providing you some insights to the overall marketplace. Oh, bear with me. I'm going to hit the right button soon. There we go. Sorry about that. So let me start off with a little discussion with Paul, just some background around the MSCI. For those people out there that may not know what the MSCI is, Paul, and of course you're an index provider in the overall marketplace, but maybe you can give me kind of 3 quick insights. I'm looking for you to give me the role of the index provider, maybe some AUM stats, number of assets are following your kind of respective indexes or benchmarks, if you want to call it that way. And then effectively, what makes you different as an index provider than maybe some of the other ones out there for like the S&P 500 and those ones out there? So give us those 3 quick insights if you can there, Paul.
Absolutely, Kevin, and let me start by thanking you for having me and wishing everyone a good afternoon. So simply put, an index provider's job is to represent the realistic investment opportunity in a market. So let's say an investor wants to invest in India, for example. Well, what does that mean? Which Indian stocks are truly accessible by a North American individual investor? And so the job of MSCI and any index provider is to determine that opportunity set, vet it, and then create an index that represents India, and then of course do the same across the world to understand the global opportunity set. Now, in terms of assets, at the moment there's about $13 trillion benchmarked to MSCI indexes amongst individual investors, asset managers, pensions, foundations, and endowments. Of that 13 trillion, about 3.7 trillion directly tracks our indexes, whether it's BMO ETFs, institutional separate accounts, all types of different vehicles. And then on differentiation between us and other providers, I think there's 2 things that really come to mind. The first is that we are much more global in nature. So the methodology for creating an index is the same across all 77 or 78 countries that we cover. That's not necessarily the same with other index providers. They tend to specialize in 1 or 2 countries, and then they have different methodologies for other places in the globe. So that similarity is unique to us. And then the second thing is that we're not number locked, right? There's no MSCI EFA 1000 index or Canada 100. All of our indexes change the amount of stocks that they have in them based on market conditions. Is IPO activity up or down? Are there more or less public companies than there were 3 or 5 years ago? And so the concept of number locking doesn't make any sense to us. And again, that makes us different than other providers out there.
Thanks for that, Paul. And you know what? I was on your website, and I'm always constantly impressed by the resources that MSCI has. And I found this site called the Insights Gallery, and it's all around COVID-19. I really think it's an interesting thing that you're now doing too, to really help people get insights in the marketplace. Maybe just a quick shout out for this, and we'll move on to the core of the deck.
Yeah, absolutely. Certainly it's topical research. MSCI is an index provider. We also do other things. Clearly, the purpose of today's discussion is ESG, but in addition to that, we do portfolio analytics, right? Attribution, really understanding why things perform the way they do. And if you think about those three elements, it makes for some pretty powerful research, particularly in the era of coronavirus. And so this portion of our website that you highlight does exactly that. Our research group certainly has been working overtime since this whole thing started.
Perfect. And for listeners out there, just Google MSCI.com, Insights Gallery. It'll come up. I encourage you to take a look at it. Nice piece of additional resource out there and well thought through. Let's jump ahead here now into the core of discussion here. We want to talk a little bit and talk about the ESG. Now, it's interesting. There's been a lot of research in this space, and more recently, for example, Bank of America itself came out with some research today, actually debunking the traditional thought process that people tend to move away from ESG in these times of market crisis, just to keep themselves more afloat. In addition, they're highlighting that some of the performance right now is actually a little bit better in ESG, and that's not just only better in this current crisis, but they also highlighted that in the 2018 kind of mini correction there, it also did well there too. So that's interesting to see how it's helping us stay more afloat in the marketplace. And we'll talk about that a little bit later on too. And of course, one thing that Moody's actually noted today in their own paper is that COVID-19 will likely change the flows towards ESG, and that's environmental, social, and governance across the marketplace. And we're starting to see that here in Canada too. Some key critical stats there too. We're seeing some flows into respective ETFs here in Canada, as well as we're seeing the same thing in the States, flows towards ESG ETFs in the United States. So certainly a trend picking up. I'm going to first actually ask Mark, a lot of people look at ESG and they're thinking about environment. Maybe you can give us a little more background. Is it just environment, or was it more than that? And maybe talk us through that.
Sure. Thanks, Kevin. And thanks once again to everyone for joining today. We appreciate it. I think when you look at ESG, you start with the umbrella term, which is responsible investment. And there's really three legs to it in different ways that you can approach it, but three key legs, which is environmental, social, and governance. And I think you're absolutely right that everyone gravitates towards environmental and kind of makes it a capital E, small s, little g. But in reality, when you start to look at investment strategies and indexes, it's actually all three intertwined. And what's really important is the fact that the governance aspect of things is really bringing through the quality of companies. You talk about the social, that's the more innovative nature of companies and staying ahead of workplace concerns. Environmental is the obvious one. Are you in a dead end industry, or are you doing things that aren't going to be something you can do in 3, 5, 10 years, and that's going to impact your company? But when you bring it all together, that's what really makes it stand out, because you're identifying quality companies that are really positioned to sustain themselves across the markets and across time. And that's why you see when you get a crisis like we've been through now, that ESG actually outperforms, because these are the type of companies that are going to be less affected by the day-to-day market noise. Thanks, Scott.
Thanks for that, Mark. And let's dive into a little bit deeper. I mean, Paul, you're a research company, you represent MSCI. You're certainly seeing a trend towards ESG. Like, why do you see that? Why do you think it's taking off right now in the overall marketplace?
Yeah, absolutely. Well, to back up some of your talking points from earlier, Kevin, the top chart I really like shows you MSCI linked ESG ETFs, but it's a global view. And you can see that in 2019, the ESG history almost in a year alone. And so far, we are on pace to do the same in 2020. There's been about $17 billion in new money going into ESG ETFs linked to MSCI indexes. And so below, there are 4 general reasons as to why we think that's the case. The first being less tolerance of corporate incidents. The example I always like to use here is Exxon Valdez versus BP. You think about the Exxon Valdez oil spill 30 years ago, catastrophic scenario, obviously. What most people don't realize is that Exxon Valdez's price only went down after that spill and had recovered pretty quickly thereafter to its original level once the cleanup began. You fast forward to the BP incident 10 years ago, and that was a percent over the course of a couple of weeks BP price for a similar type of disaster. And so these things are just magnified in the world we live in. Secondly, investors have demonstrated will to act. I'm a big believer that this really started in Northern Europe a decade or a little bit more ago. It's just gone in places across the globe, and more recently among individual investors who now value this stuff more than ever, particularly millennials and the next generation of people who are coming into more money. The third is the point that Mark just made about the understanding of the financial benefit. And, there was this perception 5 years ago that in order to be ESG friendly, you had to give up something in terms of performance. I certainly believe that this most recent market volatility, where ESG is outperformed, will hopefully dispel that notion over time. And certainly there's more research out there indicating that there is no performance penalty at all for ESG, and there might even be a benefit in terms of lower risk and less volatility. And then last but not least, improved data, improved ratings. And we will get into the nuances of what a rating entails. But the key thing to note here is that because there's more data, we rely less and less on what companies tell us and more on our own research and things that we can procure outside of that to determine a rating. Hence, ratings become higher confidence over time.
I agree. I think that rating aspect and now having the data is a whole new game changer when it comes to ESG in the overall marketplace. Talking a little bit more about that for a second, I think we just want to quickly highlight too that, a lot of people know MSCI, of course, for being the research provider of the MSCI EFI, the MSCI Emerging Markets in the marketplace, but maybe a lot of people out there don't know your work in regards towards ESG, or almost like a two companies in one kind of thing. Quickly talk about that, and then we're going to jump to something else.
Yeah, absolutely. So on the bottom left here, you can see the stats, right? We have more than 200 research analysts dedicated to this business. These are people who are sector specialists, who live and breathe their sector, understand it in and out, and rate companies all across the globe in terms of their ESG. We have more than 300 full-time employees dedicated to this business. MSCI is about a 3,300 person company, so that is 10% of our employee base fully dedicated to ESG research and ratings. And I guess the thing I would urge here is the scope and scale that's required to do it well. This is not a business that you can get into as a startup. In order to truly cover the globe, you need a lot of resources, and we have that, and we also have geographic diversification with presence in 20 countries around the globe.
Thanks, Paul. And let me turn to you, Mark. BMO's also been in this space of ESG for some time too. Maybe you can talk off of, BMO's big picture in ESG, first of all, maybe a bit about the legacy, and talk about the active ownership too, if you can.
Sure, thanks, Kevin. So I think when people start thinking about investing via ESG, you really want to see the big picture. So it's not just, what names or which stocks are in the portfolio, but it's more, the company behind the fund or the ETF, what do they stand for? Are they just jumping on ESG because it's a new trend? Or is this a company and a broader organization that really, believes in it, has been involved with it with some time, and really wants to put a footprint out there in terms of ESG? So at BMO, it comes straight from the top. So it comes from Daryl White, our CEO. He's created a whole new dynamic of how we approach our business, our interaction with customers, our interaction with our communities, and employees as well, which is caught in this message of sustaining the growth for good. And so that's got a real ESG angle to it. And it also influences the companies that that BMO works with, in terms of the capital market side, the commercial lending side, other things that we do. So the entire firm really has embraced and has been involved in this area for a significant period of time. So I think that's important to realize, the company behind the product. Kevin, if you go to the next slide. And then as well, within the investments, again, you can look at what the fund holds, but it's also this idea of active ownership. And what does active ownership mean? It means that you're not just blindly, voting along with company proposals, whether that's, on board members or executive compensation or other things that might be looked at. It's that you're challenging companies and trying to, really ensure that they're embracing ESG considerations. So when you look at, the major ETF providers in Canada, BMO certainly stands out, which is the larger blue bar of voting against management in comparison to those other ETF players, which simply means, again, that overall as a firm, across our ETF holdings, our active holdings, our mutual fund holdings, we're far more willing to challenge companies and try to enforce or at least influence some of these ESG considerations. The other element of active ownership that does come up, of course, is company meetings as well. And so there you want to know that the provider of the fund, again, is actively engaging with companies, going through research reports, similar to how MSCI does on the index side, but as the asset owner challenging companies and looking at ESG. So it's important to bring those two things together. The other thing I'd mention is that BMO Global Asset Management has been a UN PRI signatory since 2006. So that's essentially as far back as it goes, which really just means that we've signed on to some pretty stringent standards in terms of how we measure ourselves, how we report ourselves, and how we challenge on ESG. There have been other firms, of course, in the industry joining up over time, but BMO was there right from almost at the beginning. So I think that's another important consideration when you start thinking about ESG. Thanks, Kevin.
Oh, thanks, Mark. I think the active ownership and some passive management is a good combination, of course. Let me turn it to Paul. Let's talk about that research and let's talk about it, put it in motion here. Effectively, what does it mean when you're doing and studying and evaluating a company, and how do you rank things across the board?
Yeah, absolutely. So I guess the most important two things to note. First, the rating scale, and you can see that on the bottom of the screen. It's very similar to a fixed income credit scale, with AAA being the best companies, CCC being the worst. The second thing that's really important to know is we look at like companies relative to their peer group. It wouldn't make sense to compare BMO to an oil and gas exploration company in Western Canada, right? BMO is a trust-based business. Governance matters more than anything else, whereas the oil and gas example is much more environmentally driven. And so we group companies according to the industry that they are in. And once we do that, we go about identifying the handful of key issues that really drive the ESG considerations of that sub-industry and all the companies in it. And if you can move forward to the next slide, Kevin, I have an example here of what precisely that means. So this is Coca Cola and how we would rate and analyze this soft drink sub-industry. And the blue boxes on this slide are issues that we look at across the board, regardless of what business you are in. The MSCI ESG research team analyzes board, pay, ownership, and accounting. However, the red boxes are unique to the soft drink sub-industry, and they're pulled from this bank of 37 key issues that we have. For any given industry or sub-industry, you generally have between 4 and 8 red boxes issues that really drive the sustainability of that industry based on the business that they're in.
Thanks, Paul. And really want to highlight here too that in addition to the ETFs we offer in the marketplace, there are other solutions out here. Here's a sample of some of the ETFs that we offer in the marketplace are around ESG specifically. And if you want a full list of all the ESG products in the marketplace, you can get them from the Responsible Investment Association. They have a tool on their website, and we're providing a link. Just copy it down. We certainly can give you you can watch this on replay later on, but there's the actual link for itself for you to get access to every solution out there. We brought a full solution of different products in the marketplace. Let me turn it to Mark a second here and actually ask him, can you show us, give us a couple examples of what it means and how they're implemented in the marketplace?
Sure, thanks, Kevin. Yeah, I think I'd focus on the two ETFs here as the sort of more broad, full solutions if people are looking for something to complement their portfolio. I think, as direct investors, we typically have a home bias. Generally, that means Canada. It might also mean, in the US, if we have a few names we know and love, like Apple or Amazon or Google or the like. But using a broader ESG product to complement that can be a great way to add some discipline to the portfolio. So both of these ETFs would follow that. ZESG is a balanced ETF. It's about a 60-40 split equity fixed income, and it holds the underlying ETFs that are the building blocks of equity and fixed income to create that portfolio. Or if you were looking for an all equity exposure, ESGG, which would then just be equities only, again, combining the global sectors together, Canada, US, international, to build a product. And again, what these really give you that you may not have in your portfolio is a true global exposure and really much more of a broader market exposure if you're looking for something to add a little discipline to your portfolio. Thanks.
I like that. It could be a good complement to an overall portfolio. Maybe a way for people to start across the board. Hey, Paul, turning back to you. I mean, let's say people have individual stocks and they want to know how that individual stock ranks according to your methodology you went through a second ago. I know you have some resources for that. Maybe you can quickly talk to that.
Absolutely. We do have resources for that. So for about 6 months now, on our website, the ESG link, which is pretty clear, you go to MSCI.com and then ESG from there, we have offered free top-level ratings information on about 2,800 stocks globally, including all of the stocks within the MSCI Canada index. So that allows individual investors to look up and see how these companies compare to their peer groups. More recently, we've made that same AAA to CCC rating scale available free of charge for funds. So if an investor's preferred style of investing is a fund or ETF, they can now, as of this week, go to MSCI.com, look up that fund or ETF, and see what the fund level ESG rating is on 36,000 different funds across the globe. So it's a nice free resource to get yourself up to speed on ratings, how different things look according to our ratings, and then really understanding it and be able to see how it fits into your portfolio.
Thanks for that. And I think it is just one of those other factors now to look into. We have our fundamental factors we look at, technicals out there, and I think now ESG is just another factor people look into. And it's good for you to put it on your public website. And for those people out there, just Google it, MSCI.com, ESG hyphenated ratings. You will find that there, and just type the name of the company in, and it'll pull up a report just like this for you. I've used it many times, very slick. And then I also want to quickly highlight too from MSCI, I went to their website, I found some great tools on their website. If you want to dive into a little bit more on ESG, we want to give you a little bit of some insights today on ESG, but we want to keep your education going on ESG. Great, there's some great resources on their website. Just take a look at ESG101.com and that'll give you some great way to even dive into deeper on the topic of ESG. I want to flip gears here and start talking about some questions that came in this week. So let me reach out to Mark. I know we have a follow-up question from our Zed Pay last week, and we had a good focus and conversation around Zed Pay last week about derivatives. And some of this conversation is talking about, they like the approach and the convenience of Zed Pay, but, effectively, they're thinking about the market timing aspect. And I guess I turn to you, Mark, and saying, is Zed Pay one of those ETFs you use for market timing?
Sure, thanks, Kevin. I think market timing is always a challenge. So I'm certainly not going to sit here and say to attempt to time it like that. However, ZPay itself is a dynamic strategy, and what do I mean by that? Because of the options on either end, the calls and the puts, when markets fall, typically we increase our equity exposure through the puts moving into the market, into the money, and conversely, when markets rise, we tend to reduce our equity exposure again because the calls go into the money. So it's always a good opportunity to have this in your portfolio, and it will adjust, maybe not as dramatically as some are thinking between, say, cash and equities, but it does move over time. Where we've seen it move, coming into March, where equity weight was around 40, as markets fell, we got up to almost 70% equity weight, and as markets have recovered, we're back down to just north of a 50% equity weight. So there is an opportunity within the ETF itself to be dynamic and respond to changing market conditions. If you're really pro-market, I think you want an all equity exposure, but if you're looking for an income-oriented alternative, something to complement what you have, and that's dynamic, I think ZPay is a great thing to think about. Thanks.
Thanks for that, Mark. We actually have some couple of questions coming in the audience here around currency hedging. We had a session on this a while in the back, so I encourage everybody to take a look at that. It's on the replay on the system here. But ultimately, let me just go to Mark here. Let's have a couple of questions around currency hedging. First of all, how does currency hedging work with inside an ETF?
Sure. What you do with a currency hedged ETF is you take on a position in the currency to offset the currency exposure of an equity. So, if I take a simple example of holding Apple, there's really two things going on. There's the return of Apple in US dollars, but as a Canadian, there's the return of USD versus CAD. So what that currency hedge does is it takes a short USD exposure, which cancels off the currency exposure with Apple. So generally speaking, you get a return that's very similar to the local return or the US dollar return of Apple. And within the ETF, this is something, of course, that we deal with all the time. We roll the hedges on a monthly basis just to keep truing it up as the market value of securities change and other things are moving around in the portfolio. Thanks, Kevin.
So the second question dives a little bit deeper into the same currency question because people can now, of course, see the full transparency of an ETF and see all of the holdings. So this person took the time and effort and looked at one of our US S&P 500 ETFs, the Hedge one, ZUE that is, and saw with inside there that there's roughly a 2% currency forward, and was really kind of get a question of saying, is that the cost that's spent to hedge these contracts on a regular basis? Mark, maybe you can talk to that.
Sure. There's really two costs. There's one, the actual trading costs, and we trade at institutional level, so it's pretty benign. So over the course of a year, between monthly rolls, it's really going to only be around 10 basis points or so, so 0.1%, so very, very low, very minimal. But what you do need to think about is the interest rate differentials. So without getting into anything that's not too exciting, if there's a significant difference in the short-term interest rates of two countries, that will affect the movement between the currency forwards over the course of that longer time period. So if U.S. rates are higher, then you're essentially paying through for that higher rate of interest. And by and large, Canada and the U.S. have pretty similar interest rate forecasts. However, you do see some differences due to the differences in our economies, and the strength of our economies, where, as things get a little more volatile, sometimes those spreads get a little wider. So that's a second consideration to keep in your back pocket. But relative to the movement of the currency itself, it's certainly a secondary consideration. So if your goal is to get rid of U.S. currency exposure because you think that's going to decline relative to the Canadian dollar, then that hedge, by and large, is going to do exactly what you're looking for it to do. Thanks.
And the 2% is not necessarily the cost of the hedge; it's just what maybe the offsetting value became over that month, as you mentioned before.
Right. Yeah. Exactly. So that's a future return, and then again, it's always relative between the two currencies.
So let's talk a little bit, and these are our last question, just monitoring the time here. Of course, asking the various recommendation in various Canadian ETFs. Now, we're really trying to provide insights here, but the part of this question I really like to dive into, if you can, Mark, is looking for high liquidity, right? So effectively looking for ETFs with high liquidity. Maybe you can talk to us a little bit about liquidity in ETF and the considerations around liquidity of an ETF.
Sure. Well, I think you need to understand, without getting into the mechanics of it, that the ETF always can access the liquidity of the underlying portfolio. And that's just because an ETF can grow and shrink as there's more and less demand. So unlike a stock, which is completely dependent on the bids and the asks because there's a limited number of shares outstanding, an ETF can create and redeem all day long to really address demand. So, if you're looking at an ETF and it has lower day-to-day volume, maybe it doesn't even trade one day, that doesn't mean it's illiquid if it's accessing an underlying basket of liquid securities. So, something on Canadian banks, US banks, I think was in the question, because those securities themselves are so liquid, the ETF is going to carry that same liquidity, and the spread of the ETF won't get much wider than the spread of those underlying bank stocks. So it's not a concern as long as you're dealing with a large liquid underlying asset class. It's just when the underlying asset class maybe is more narrow, is tougher to trade, is a little more illiquid, you just need to understand that relative to the ETF. And then typically the ETF, in that case, adds liquidity compared to the underlying. If I could just give you a couple of quick trading tips. Always use limit orders. That just ensures that you're going to get the execution at the price you want. Of course, revisit those limit orders if the markets are moving. Avoid trading right at the open of market or close of market. Try to trade during the day. But just realize, just like a stock, you've got the underlying, like the underlying stock, you've got the underlying liquidity to tap into as the ETF. Thanks, Kevin.
Thanks, Mark. And I'm going to thank everyone for taking the time again to join us this week. We really appreciate you joining us. We're going to be back again next week at 1 o'clock with our guests from MSCI. If you're going to share with your friends what the story is going to be next week, I'll let you know in a little bit in advance. We're going to talk about the broad market indexes that MSCI offers in the marketplace, give you some insights around them, and then talk a little bit about quality as a factor and how that's working in these current markets across the board. So I appreciate both Mark and Paul joining us today, and I appreciate each one of you taking the time to A, share your questions with us, and B, join us on a regular basis. Thanks so much. Have yourself a good weekend. Cheers.